The company that revolutionized our phones is now coming for our wallets, and most people haven't even realized it's happening. Think about this. When was the last time you used your physical credit card instead of Apple Pay? For millions of people, plastic cards are becoming relics of the past, like CDs or paper maps. But Apple isn't just replacing your wallet, they're slowly becoming your bank. You've probably noticed Apple's growing suite of financial products: Apple Pay, Apple Card, Apple Cash. They seem like convenient features, but they're actually the foundation of what might become the world's most powerful financial ecosystem, and it's happening right under our noses. But here's the thing that most people miss. Apple isn't building a traditional financial company, they're creating something far more valuable, a financial technology layer that sits between you and the entire global banking system. And they're doing it without taking on any of the traditional risks or regulations that banks face. Let me show you why this matters more than you think. The traditional banking system is built on infrastructure from the 1970s, ancient technology that's expensive, slow, and riddled with middlemen who all take a cut. Apple saw this inefficiency and realized there was an opportunity to insert themselves at the perfect position in the value chain, right at the consumer interface where all the loyalty and trust exists. You already know Apple makes beautiful devices, but do you understand how they're leveraging that hardware dominance to control the software layer of finance? This isn't just about convenience, it's about power and profit. So today, we're going to explore how Apple silently transformed from a computer company into a financial giant, why traditional banks should be terrified, and what this means for your money going forward. Time to pull back the curtain on how Apple became a financial powerhouse without anyone noticing. Let's start with some context. The global payment processing market is worth over $2 trillion annually. Credit card companies typically charge merchants between 1.5% and 3.5% on every transaction. That's an enormous pool of money that has traditionally gone to banks, credit card networks, and payment processors. Apple looked at this system and asked a simple question: why can't we get a piece of that? When Apple Pay launched in 2014, most people saw it as a simple convenience feature. Tap your phone instead of swiping a card. Nice, but not revolutionary. What most missed was the business model behind it. For every transaction made with Apple Pay, Apple receives 0.15% of the purchase amount. That might sound small, but let's do the math. Apple Pay processed over $6 trillion in transactions in 2023 alone. At 0.15%, that's roughly $9 billion in revenue just for facilitating payments, no lending risk, no regulatory headaches, just pure profit for controlling the interface. But Apple Pay was just the beginning. The real strategy became clear when they launched the Apple Card in partnership with Goldman Sachs in 2019. Now, you might think that the Apple Card is just another credit card with Apple's logo slapped on it, but that completely misses what's happening behind the scenes. Traditional credit cards make money in three ways: interest charges, annual fees, and interchange fees paid by merchants. The Apple Card has no annual fee, and Apple designed it to encourage users to avoid interest charges with intuitive payment tools and transparency features. So how does Apple make money from it? By taking a cut of the interchange fees that would normally go entirely to the bank. Goldman Sachs is the actual issuer handling the regulatory compliance, credit risk, and banking infrastructure, but Apple gets the customer relationship and a significant portion of the revenue. Apple effectively outsourced all the regulated low-margin, high-risk parts of banking to Goldman Sachs, while keeping the high-margin, consumer-facing elements for themselves. Goldman takes the risk, Apple takes the profit. And it worked beautifully. At first, by 2023, the Apple Card had over 12 million users and a loan portfolio exceeding $16 billion. When was the last time you saw a tech company build a multi-billion-dollar lending business in just 4 years? Here's the crazy part. Goldman Sachs reportedly lost over $1 billion on the Apple Card program, while Apple continued to profit. Why? Because Apple owned the customer relationship, controlled the interface, and took a cut of the transaction revenue without assuming any of the risk. Think about it. Apple created a financial product where their partner lost money while they made money. That's not just good business, that's financial alchemy. But Apple's financial alchemy didn't come without consequences. As of January 2025, Apple has been actively negotiating with Barclays and Synchrony Financial to replace Goldman Sachs as the issuer of its Apple Card. Goldman Sachs decided to scale back its consumer-focused financial products due to those sustained financial losses and increased regulatory pressures. This strategic transition perfectly demonstrates Apple's agility in adapting its financial ecosystem. When one banking partner becomes unprofitable or problematic, Apple simply finds another who's willing to handle the regulatory compliance and credit risks, while Apple maintains control over the user experience and a portion of transaction revenue. The bank might change, but the Apple Card experience remains seamless for consumers. Time to pull back the curtain on Apple's true fintech ambitions. After conquering payments and credit, Apple set its sights on a new frontier: buy now, pay later. In 2022, Apple announced Apple Pay Later, which allowed users to split purchases into 4 payments over 6 weeks with no interest or fees. This put them in direct competition with companies like Affirm, Klarna, and PayPal's Pay in 4. The buy now, pay later market exploded during the pandemic, growing from $33 billion in 2019 to over $120 billion by 2023. Initially, unlike other BNPL providers, Apple didn't partner with a financial institution to launch this product. They created a wholly owned subsidiary called Apple Financing LLC. This was a fundamental shift in strategy. For the first time, Apple was actually extending credit directly to consumers. They had become the lender. But here's where things get interesting. In June 2024, Apple discontinued its direct-to-consumer Apple Pay Later service, pivoting to partner with established BNPL providers like Affirm. This significant strategic shift allowed Apple to remain competitive in the growing BNPL market without directly assuming lending risks and regulatory scrutiny. This move perfectly illustrates Apple's financial playbook: test direct involvement, assess the risks and rewards, then strategically partner when it makes sense, all while maintaining the customer relationship and user experience that drives loyalty. But here's what makes this truly brilliant. Apple has access to data that traditional lenders can only dream of. They know what phone you use, how often you upgrade, what apps you download, how you use those apps, and your entire purchase history through Apple Pay. This data allows them to make lending decisions in a completely different way than traditional banks. While banks rely heavily on credit scores, Apple can use behavioral data and spending patterns to assess creditworthiness. They can see if you consistently buy new Apple products, suggesting brand loyalty and disposable income. They can analyze how you interact with financial apps. They even know if you pay your Apple subscriptions on time. And Apple is just getting started. In 2023, they announced Apple Savings, a high-yield savings account in partnership with Goldman Sachs. By 2025, this account was offering an impressive 4.15% annual percentage yield on deposits. Users can automatically deposit their Apple Card cashback rewards into this account, creating another touchpoint in the Apple financial ecosystem. This creates a virtuous cycle. Use your Apple Card, earn cashback, deposit it into your Apple Savings account with that attractive interest rate, watch it grow, spend more using your Apple Card, all within the Apple ecosystem. The success of this high-yield savings account significantly boosted customer engagement within Apple's financial ecosystem, promoting increased usage of the Apple Card and incentivizing users to manage more of their financial activities directly through Apple services. Now, you might think, isn't this just a marketing ploy to sell more iPhones? That's the genius of it. Yes, these financial services help sell more Apple hardware, but the financial services themselves are becoming massive standalone businesses. It's a perfect symbiotic relationship where each part of the ecosystem strengthens the others. Time to pull back the curtain on why traditional banks should be terrified. Banks have always worried about fintech startups eating into their business, but most fintech companies still rely on banking partners to provide the underlying financial infrastructure. They're essentially building new interfaces on top of the old banking system. Apple is different. They're not just building a better banking app, they're gradually reconstructing the entire financial stack. Consider this scenario. You're a 22-year-old who just got your first job out of college. You've been an iPhone user for years. You already have Apple Pay set up and use it daily. Getting an Apple Card is as easy as tapping a button in your wallet app. You use it for all your purchases to get that daily cashback. Your cashback automatically goes into your Apple Savings account. When you want to buy something expensive, like a new MacBook, you use Apple Pay Later to split the payments. For this consumer, Apple has become their primary financial provider without them ever setting foot in a bank branch. Their paycheck might still be deposited at a traditional bank, but all their daily financial interactions happen through Apple. This is the nightmare scenario for traditional banks, being reduced to regulated utilities that hold deposits while consumer-facing technology companies own all the valuable customer relationships. time to pull back the curtain on Apple's global financial ambitions. While most of Apple's financial services have focused on the US market, their global ambitions are becoming clear. Apple Pay is now available in over 70 countries, far outpacing the geographic reach of most fintech startups. They've been methodically expanding, country by country, establishing the foundation for their broader financial ecosystem. In markets where credit cards are less common, like China and parts of Europe, Apple has adapted by supporting local payment methods. In China, they support WeChat Pay and Alipay through Apple Pay. In Germany, they support Giro cards. This flexibility allows Apple to insert themselves into local payment ecosystems regardless of the underlying technology. And once they've established themselves as a payment provider, they can layer on additional financial services tailored to each market. Now you might think, but surely regulations will prevent Apple from becoming a global financial powerhouse. This is where Apple's strategy is so clever. They're not trying to become a fully regulated bank in every country. Instead, they're partnering with local financial institutions while controlling the customer experience. It's like Apple is saying to banks around the world, you handle the boring, regulated parts of banking, we'll take the customer relationship and a cut of the revenue. And banks are agreeing to these terms because they fear being left behind. They'd rather have some role in the Apple ecosystem than no role at all. Think about traditional banking as a vertical stack. At the bottom, you have the basic infrastructure, payment rails, core banking systems, regulatory compliance. In the middle, you have products and services, checking accounts, credit cards, loans. At the top, you have the customer relationship, the apps, interfaces, and touch points where consumers actually interact with their money. Historically, banks controlled this entire stack, but Apple is systematically taking over the top layer while leaving the bottom layers to traditional financial institutions. Why is this strategy so brilliant? Because the top layer, the customer relationship, is where all the value is being created in modern banking. The rest is increasingly commoditized. Here's a statistic that puts this in perspective. According to McKinsey, banking activities related to distribution, the customer-facing layer, generate about 65% of profits in the industry while consuming only 35% of resources. Meanwhile, manufacturing banking products, the infrastructure layer, generates only 35% of profits while consuming 65% of resources. Apple has effectively skimmed the most profitable parts of banking while leaving the capital-intensive, low-margin operations to traditional financial institutions. This isn't just clever, it's transformative. Apple is changing what it means to be a financial services company in the digital age. So how does Apple's transformation into a fintech giant affect you personally? First, it means more convenience. The days of carrying a wallet full of plastic cards are numbered. Your iPhone and Apple Watch will increasingly become your primary financial tools, handling everything from daily purchases to saving for retirement. Second, it means more integrated financial services. Rather than dealing with separate apps for your bank, credit card, investments, and loans, you'll manage more of your financial life through Apple's ecosystem. This integration will likely make financial management simpler and more intuitive, but there are potential downsides too. As Apple gains more control over your financial life, you become more locked into their ecosystem. Switching from an iPhone to an Android device becomes harder when your entire financial infrastructure is tied to Apple. Then there's also the question of privacy. Apple has built its brand partly on privacy protection, but as they collect more data about your financial habits, the potential value of that data increases exponentially. Will they maintain their privacy-first approach as financial data becomes a larger part of their business? And let's not forget about regulatory challenges. In November 2024, the Consumer Financial Protection Bureau fined Apple and Goldman Sachs over $89 million collectively due to deficiencies in handling Apple Card-related consumer disputes, credit reporting inaccuracies, and lack of transparency in credit limit adjustments. This event marked Apple's first major financial regulatory setback, underscoring the complexity and risks associated with expanding into financial services. Apple has since increased investments in compliance and risk management to prevent similar future occurrences. But it raises an important question. Can a tech company truly navigate the heavily regulated world of finance without eventually facing significant consequences? The broader implication is that as Apple becomes more entrenched in the financial system, traditional financial institutions will be forced to adapt or risk obsolescence. We're likely to see banks investing heavily in their own digital transformations, partnering with technology companies, or potentially consolidating to better compete. For consumers, this competition should lead to better services, lower fees, and more innovative financial products. But it also raises important questions about data privacy, market competition, and financial inclusion. Not everyone owns an iPhone. Will people without access to Apple's ecosystem be left behind as financial services increasingly move to these platforms? This is a question regulators and policymakers will need to address. So, where does this leave us? Apple's transformation into a fintech giant has happened so gradually that most people, and perhaps even many traditional banks, haven't fully grasped its significance. They didn't make a big announcement saying, "We're going to disrupt the financial industry." Instead, they methodically built a suite of interconnected financial services that leverage their existing hardware and software advantages. This approach has allowed them to sidestep much of the regulatory scrutiny that would come with declaring themselves a bank, while still capturing much of the value in the financial services value chain. The statistics tell the story. With over 1.8 billion active devices worldwide, Apple has a larger potential customer base than any bank. Apple Pay is accepted at over 85% of retailers in the US. The Apple Card has become one of the fastest growing credit cards in history, and their financial services revenue is growing faster than almost any other part of their business. But perhaps the most telling indicator of Apple's fintech ambitions is their massive investment. In February 2025, Apple announced a monumental investment exceeding $500 billion in the United States over the next 4 years. This massive financial commitment is expected to enhance Apple's technological and logistical infrastructure, supporting innovation and the development of new financial services capabilities. Alongside this investment, Apple has been aggressively recruiting in the financial sector. In recent years, they've hired hundreds of employees from traditional financial institutions, payment processors, and financial technology startups. These aren't just engineers, they're seasoned financial professionals with deep expertise in banking, payments, lending, and regulatory compliance. This isn't a side project for Apple, it's a core strategic initiative that could reshape the company's future. By investing heavily domestically and building out a team of financial experts, Apple aims to position itself at the forefront of financial technology, infrastructure, and innovation. And this brings us to the bigger question: what happens when the world's most valuable technology company becomes one of the world's most powerful financial services providers? We don't know exactly how this will play out, but one thing is clear: the line between technology and finance is blurring, and Apple is positioning itself at the center of this convergence. For consumers, this means our financial lives will become increasingly integrated with our digital lives. For traditional banks, it means adapt or risk irrelevance. And for Apple, it means a new frontier of growth beyond hardware sales. The company that revolutionized how we communicate is now revolutionizing how we pay, save, borrow, and invest. And they've done it so smoothly that most people haven't even noticed.